Hey there, traders. How are we all? Right, so I'm getting ready to release the Fundamental series, and I thought what I should do first is go over all the technical stuff that you guys have learned so far and go over the criteria in more depth. All right, so this may be a little bit of a long video. I'm going to try and keep it under an hour. Um, and please just kind of bear with me, all right? Because all the videos that I release are kind of done when I feel like it. Um, it's all on my time, guys. I'm not making any money or anything from any of this sort of stuff. So please respect that. There are many of you do, but there are a select number of people that just don't. They're just very demanding, and that really puts me off. That really makes me question why I do this in the first place. All right, so let's get back into it. Now, here's the common issue that I've had with many emails that have come through the sessions we've done. That and I fully accept this, that everyone has different personalities. You're coming from different backgrounds, different levels of education, different training, and in a lot of ways, all of that corrupts your approach to Forex and how you see it. The other thing is that many of you had various level of training when it comes to Forex, like different courses and different videos and all of that sort of stuff. And that can corrupt your approach to trading as well. The thing is, with many of these things, well, all the personal stuff, for example, you've got to understand that Forex really is going to make surface everything that's within you that you may not like. For example, if you've got fears, Forex will really hammer into those fears. If you take trades and then you later realize that there was actual no setup, why did I take that trade? You've got to go back and you've got to reassess that what was it within you that enticed you to take that trade. So I've said this before, trading forex will make you, or not make you more spiritual, but it will be a very spiritual journey that you kind of undertake. Its self-reflection is massive, right? That's huge. The other thing is, what I gather that's a major issue with the forex trading industry, and which is also the reason why I ask all of you to kind of stay away from groups and forums and signal services and things like that, is that there are too many opinions out there. There are too many know-it-alls out there. There are too many people with preconceived notions out there, right? And everyone is going to tell you, my way is the only way. What I can say to you is that pretty much everyone is trying to do exactly the same thing, which is determine the trend and trade along with it. That's all. No one wants to trade a ranging market, because a ranging market will go up and down, up and down, up and down, and at no point in time will you be certain, beyond maybe where the support and resistance areas are within the ranging market. You won't know exactly when it's going to do what, and that can be a real issue for a lot of traders. Whereas when we're going for with a trend, the key thing is, so if the market's trending down, we're always looking for a lower high and a lower low, right? So if that continues to happen, the market goes up here and creates another lower high, then we're expecting the market to continue going down. And it's at these points that we expect our EMAs to kind of come and interact with price, or vice versa. And it's at these points where we're looking for the patterns to happen, the double tops, right? And if the market is trending up, again, our EMAs would be here, and we'd expect our double bottoms or head and shoulders patterns to be here. That's basically all we're looking for, all we're doing. Pretty much all the traders out there do exactly that. Some of the traders would be wanting to trade these areas here, going back to these EMAs. And from experience, you guys, and also these ones here coming back to the EMAs, and experience would have told you guys that a lot of the times price may not make it back to the EMA. It may be somewhere here before it comes down. or if maybe there's a false move here and the market continues to go down, something along those lines. And that's where they get caught. These are where you get 60-70% returns, or 60-70% hit rates. So what we do is we establish rules around this sort of structure and this sort of structure. Because in reality, this is all you're looking to trade. That's it. There's nothing more than this. With those that use technical indicators, what the indicators would be telling them is these sorts of moves anyway, right? The problem with the indicators are that by the time that these moves are kind of registered, the move when like the setups are registered with the indicators, the moves have already happened. The issue that I have with signal services is that beyond them saying, okay, here's where price may be, and they'll just do this. They'll go across to see where price is at that point in time. To say maybe when price gets to here, short the market. And price at that point in time may be here. Now, we know that when price gets back to our EMA, the chances of this bouncing back is quite high. What we don't know is if price is going to bounce straight off the EMA, or if it's going to break the EMA, or say for instance if it's an EMA 200 where price, so this is the EMA 200, price goes above and then does something like this before it comes back down, and the distance from here to here in pips maybe 50-60 pips or so. So that's the reason why I'm kind of against the signal services, because they might get the direction right, the overall trend, but entry is a real issue with that, right? And that's why a lot of the times when bank advisories come through, that they will take entries at certain points because they're looking at higher time frames. They're looking at maybe a structure on the daily chart, but on a 15-minute chart, that whole range, when we're talking about zones in support and resistance. So if this is a resistance area, then we might have a zone. And for example, using Fibonacci, this might be 618, and that probably would be 786. And the distance between here and here might be 20, 30, 40 pips or so. So if on a daily chart, the setup happens around here, but on a 15-minute chart, market may go up here somewhere to create a structure before it comes back down, right? So you'd be in drawdown for what number of how many other pips exist within this space. So that sort of stuff. And that's, again, reasons why advisories from banks, signal services aren't ideal. Because remember, keep in mind, you're not an institution trader with massive pockets, deep pockets. You're a retail trader, and you'll have in your mind some degree of drawdown that you can safely absorb, right? So in short, guys, that's what we're trying to achieve. That there's got to be a trend, and within that trend, there's got to be some interaction, some area that the market comes back to, interacts with it, creates some sort of structure that gives us a confirmation it's moving back in this direction of the trend. And we take an entry based off something that's familiar, which in this case would be a clear market structure that we'd recognize. Okay? All right, let's clear this. Now, let's just quickly have a look at some examples. Let's see what we've got here. So basically, this is all I'm saying. Our strategy is the interaction with the EMA. So in this case, see how price moves up towards the EMA 800. Now, if we were to say, let's just take a trade straight off where the EMA, where price hit the EMA 800, well, and this is pound AUD currency pair. So just off the hit of the 800, look at that. The amount of time that price spends above the 800 is probably about a good 10 hours or so. But beyond that, it's gone up about close to about 50 pips from the EMA 800 itself. So what we want to do is say, let price do whatever the hell it wants to do up here. And then once it comes back down to the 800 and breaks it, does a retest, then we can look for an entry. And within this space here, what we're looking for is some sort of structure that we recognize. So that could be a double top, it could be a head and shoulders pattern. Now, here's where a lot of new traders go wrong. Everyone's expecting very clear patterns to happen, right? Don't, because the market's not always going to give you clear patterns. What you do want to be able to decipher is this second part. The second part where the market actually has created that whole double top formation, and then it's done a confirmation candle, a strong one coming down. So let me draw this back here again. I also get a lot of people saying, Shiva, in real time, it's very difficult to decipher if there is structure. It's not. Here's the reason why. Many of you are looking to do this, that you were trying to get this happening and taking your entry here. Many of you are probably just looking at this as a resistance area. Please don't. Yes, a lot of courses out there teach you that sort of stuff, but don't. What I'm suggesting is let the market go, create its pattern, and see by the time it gets to here, which is the middle area of this M formation here, right? And with a head and shoulders pattern, it would be something along the lines of, and there might be some structure here. So grab your diagonal line and draw that in. Let this formation complete. With a head and shoulders pattern, what's also important is that this breaks, right? This bottom part breaks, and maybe a retest happens here of this line, because you could always have price bounce back off that line as well. With a double top formation, you want this double top to be created, right? This is where your confirmation candle would most likely be. This area here may be that candlestick structure that you really recognize. Okay, so maybe like an evening star pattern or a nice engulfing candle. But for all extents and purposes with trading, you want the full structure to complete. Why? Because when this structure creates a double top formation, now let me clear this. See, up here, when this structure does this and then goes back up and then comes back down again, it's only see this middle area here when we say, okay, that once that's crossed, yes, we know that this market's going to continue to go down, right? Don't get greedy here. Too many people are trying to capture your entries right at the top. That's what's going to screw you. Wait for price to clear this middle area and then look for your entries wherever. Now, because this is a higher EMA than the EMA 200, if price is still at a fair distance between the 200 and wherever it is, you can take your entry, right? But for all extents and purposes, please use the EMAs, like especially the 50, 200, and the 800, as a support and resistance area, dynamic support and resistance area. So be careful of how you take your entry. But wait for this whole confirmation to happen. Notice how this happens at London Open, right? Or this probably would be Frankfurt Open. Those are the times that you're more likely to see the bigger moves happen, right? So it's always worthwhile to wait. London Open, New York Open. Sometimes the market may start doing moves during the Asian session, right? That's all good and well, but make sure it's a setup that happens around at least your EMA 50 or EMA 200, right? A lot of the times within Asian session, the market may move because of fundamentals, especially on a Monday. Things that have happened over the weekend that will contribute to what the market does. For example, yesterday we had London market and New York markets closed, but you saw significant moves with the euro, and that was simply because of the news that came out of Italy over the weekend in regards to their elections and the parties and whatever else is going on there. So the Italian stocks were being sold, and that was also affecting the euro. So we're going to get, when we get to fundamentals, we will talk about how to know what sort of information is affecting the move of the market, right? So going back to what we just discussed with the patterns, so we're expecting price to get back to an EMA and then create some sort of a pattern, create a confirmation candle, clear the middle area, and then it's going to continue going. So that's where you want to start taking your entries. Now, if you do it this way, you might have maybe drawdown where price comes back to an EMA to retest, or maybe the candles consolidate for maybe 15 minutes or 30 minutes or so. But if your entry is precise, you will be in the money pretty much straight away. You probably won't have a massive drawdown where the market just kind of moves against you for a prolonged period. And for all extents and purposes, you should be in the money very, very quickly, right? If that's not happening, there's something that you're doing wrong with this strategy overall, right? So instead of going ballistic over it, just sit down, analyze, right? I'm going to go through a list of issues that I've picked up with people from emails and doing sessions of things that they're still kind of going wrong with. And I tell you, all of this can actually be fixed if you just kind of follow the criteria. Okay, so here's that at the EMA 800, price comes down, breaks the 200. What do we do? What are we expecting every time an EMA gets broken? Um, we expect a candlestick retest, which is where the next candle will probably, so if this is the EMA here, a candle breaks here, we're expecting this candle to open and a wick to come towards the EMA to retest, right? And then that may close off here or something along those lines, maybe a doji or something like that. Does it happen all of the time? No, but we're always going to expect it. The other thing that we want to see is that chances are price will find its way back and create a structural retest of that EMA, right? So in this case, when the EMA 200 breaks here, what we're expecting is at some point price is going to come back and then hit the 200 again, right? When it comes back for a secondary hit, as in this break, and then price comes back. See, this one here doesn't quite hit it, but this does certainly come back to hit it. Now, without zooming in, can you see what this kind of looks like to you, right? That is a bit of a double top formation, right? So when price goes up, and this is Asian session, it comes straight back down again. We've got one part of this currency pair being a Asian session pair, so we can trade this. When price breaks and hits below the 200, we can expect price to fall. That's where you take your entry. Chances are you'll probably be in the money straight within 15 minutes or half an hour or so. That's all I'm asking you to trade. So when market is looking like it's trending down, why? Because our EMAs sit above price. So the big EMAs, 800's up there, 200's up there. For all extents and purposes, this market's trending down. Even here, when this market for, say, 4 sessions or 5 sessions is trending up, EMAs are still above, or the bigger EMAs are still above price. So over the longer term, this market is still trending down. So what we're looking for is structure at the EMA going in the direction of the trend. So notice this, all we're doing up here is looking for entries at the EMAs. So, okay, couple of rules. Remember, our trading times during the Asian session for Asian pairs, we'd like it to be especially after the Japanese markets opened, right? So I'd say a few hours into the Asian session and then after that. But most likely Frankfurt, London Open, New York Open. If nothing happens within the first few hours of New York Open, please do not trade the second half of it, right? Simply because volumes tend to fall during after lunch New York session. You notice that why we say the bulk of the moves tend to happen London Open, New York Open, because that's where the bulk of the news releases tend to happen, right? Something I have mentioned in the past, understand this. Technical analysis are just receipts that we're seeing of orders coming through, right? Or orders that have actually already been transacted. And what forces the market to kind of move in these directions are a combination of fundamentals and market sentiment, which is how the market actually feels about the fundamentals that are coming through. And those fundamentals could be things like news releases that give us an indication of whether that economy that's related to that currency is um, shrinking or it's growing bigger, right? That's all we're looking for. And if the economy is shrinking, chances are that currency is going to weaken. If the economy is getting bigger, that means it's strengthening. That currency is going to strengthen. And that's kind of the gist of fundamentals that we're going to be looking at. But just for technical analysis, here's what I want you to be doing is if the market is trending down, don't look for these reversals. Don't look for these reversals going back to the EMAs because we don't know where that's going to go to, right? What I want you to do, because, for example, it could just go to the EMA 50 and that's it. It may break the EMA 50 and go to the 200. It may break the 200, go all the way to the 800. It may break the 800, go all the way to the 3,200. In real time, you will never know this. So don't try and trade this. Too many traders that I've seen have been trying to kind of counter this. And a lot of the losses they have is because they take an entry and they'll say, but Shiva, this looked like a double bottom formation to me. But the point is that I didn't teach you that, right? So you can't say to me that this criteria is not working because you're doing the opposite of what the criteria actually is, just because there's a structure. Remember, these structures, these have been around since when charting actually began. I think it was in 1906, 1907 with stocks. These have existed for over a century. And the key thing about these are that they will happen everywhere. What you need to know is where to look for them, because it's here. A double bottom means nothing to me. It will only make a difference to me if price was going up and this was my EMA and double bottom formations happen like this. Right? These M's that would happen here, these double top formations coming back to an EMA, most likely, I probably wouldn't be looking to trade them. Maybe on a Friday. Why? Because on a Friday I'm expecting a correction to happen, right? But during the week, I'd probably ignore all of these. So just like here, ignore the double bottom formations that happen all the way down here away from EMAs because you're going against the tide, you're going against the trend. You are more likely to be in the money quicker if you're moving in line with the trend. And basically what this means is that the bulk of the institutions out there are all aligning their setups or their entries in line with this trend. So if you want to go against it like this, here's a double bottom formation, you're being cocky. Here's a very clear example. Let me get rid of all of this. So I'll show you. Zoom in a little bit. Here's an example of where you see a double bottom formation possibly happening and market pushes up. And you could, in your mind, be predicting, all right, this is going to go at least to the EMA 50, right? Notice how it doesn't even touch the EMA 50 at all during that entire day. These are the sorts of setups or predictions that can really kill you. So your best bet is to always look for an entry up the top. Now, if price would have hit the EMA 50, that's where you're looking for an entry after the market gives you a double top formation off of here. Or, and this is the only time that it's acceptable, if you are trading off the EMA 200, you're looking for a market structure. Market structure may not be 3 or 4 candles. It may be something along these lines. See this? Goes over 2 sessions and then comes down. This is over 2 sessions, comes down. Where do we take our entries? This is a singular session, but market still comes back up again. It doesn't continue moving down, doesn't create more lower lows until it gets to, say, 2 or 3 sessions later. Just quickly again, where do we look for our entries? Here's the middle part. The middle part. Look for the middle part. All right, here, middle part. Let the market clear this area. If you're looking to take entries because you think, okay, this is going to happen up here, then it's okay. Yes, it's okay because you will be caught. I mean, eventually the market moves down, but you will be caught up in this whitewash, right? So it's always best for the market to kind of give you a very, very clear entry before you head down. Now, here's something that I want to make clear. People keep asking me about putting live trades up. There's two options. One is if I could do that after I've taken my entries, because the one thing I do not want to do is put my account details, how much money I have in my account, the number of lots I trade, all of that sort of stuff out there in public. I don't run groups. I don't sell courses. I don't provide signal services, that sort of stuff. That's never been my intention. My intention is always to get you guys to learn how to fish and then go do this yourself. Also, here's the one thing that I have a real issue with in regards to all of these things. Guys, I'm not committing to um, doing this or running this like a business for the next 5, 10 years. Remember, I've already sold my company, I've already retired from a day job. I do not want to come back into a day job. And right now, a lot of the times when I'm moving away from doing the videos and stuff, it's partly because the emails, the messages, all of that get to a point where I'm spending 4 or 5 hours a day doing some of these things. And every time I do this, and every time it takes one wacko to send me something odd to kind of ruin my mood, and I question why I'm doing this in the first place, right? So I don't want to commit to something whereby you guys become reliant on it. I want you guys to learn to trade yourself. And that's part of the reason why I do this. I know many of you get disheartened when your setups don't go along according to plan, and you want to know if this is all real and if this can happen. It's a $5 trillion forex market. It's been around for a long time. If this wasn't real, if all of this stuff really wasn't real, this market wouldn't have lasted for this long. You wouldn't have institutions and traders out there um, trading constantly, because it's not a one-way street. Every single trade anyone takes requires a counterparty to that trade. So yes, people are losing money and people are gaining money, but that $5 trillion, which is also growing still maintains the market. It's still there, that amount of money. Okay, so please just kind of focus on the setups, the trade, because you're trading with yourself. You're not trading against someone else, and you're not reliant on someone. The moment too many people start to become reliant on me is the moment that whole purpose that I kind of started this on is gone. So I will lose interest and I'll walk away. I guarantee you that. So here's the thing, there are going to be times when I probably will, right? A lot of the times I don't trade at a time when I'd like to create a video or talk you through it or whatever it is. So I kind of stay away from that. But whilst you guys are trading, what I want you to do is to understand how I look at this, which is simply, when you're saying, well, Shiva, I can't see a double top formation in real time. Of course you can. Look at all of this. I don't take my trades up here, I take my trades down here. So when the market is down here, this whole structure up here has already happened, right? So I take my trade after that point. This whole structure's already happened. So what do you mean that you can't see the structure happening in real time? The only time you wouldn't be able to is if price is up here and you're looking to take a trade here somewhere. Let me zoom into that. So here, if you look to take your entry here, right? A couple of things wrong with this that I would say is, if it's so close to Frankfurt or London Open, be wary. Look to see what news releases exist out there as well. If there's news, and again, fundamentals will play a part in this. If there is news, the market's kind of expecting something to be released at a certain point in time, which is a few hours away, then you might reconsider taking your entry. You might also say, okay, if I take my entry here, here's the middle area for this structure, right? So you'd probably say, okay, I'll take my entry here. But you've also got your EMA 200 that's sitting here, which is, again, remember, a dynamic support and resistance zone. So what you might say is, okay, I want to wait till this gets crossed, right? So this candle here crosses, and then you say, okay, I'm expecting a bit of a pullback. Now, this may be an entry where you take it because you say this middle area is being crossed, right? But then the market goes against you. That's 19 pips. The high of that is 29 pips. Realistically, what we would have done is take, and you can do this with your 200s, EMA 200s. You can put a slightly bigger stop loss on there simply because you are expecting the market to bounce down from the 200 if it's giving you structure, right? So here's something I did see last week. I didn't trade this simply because, actually, no, I traded this down here, not up here. Simply because there was a news release that was set to happen. And when you're kind of uncertain about the news release, there are lots of times when I look at news releases that are going to happen, but I'm kind of too tired or too lazy to go investigate as to what the possible release might be. And when I'm in that situation, I'd stay away from it. Okay, guys, let me stop there for a second, and I want to make this very, very clear, right? Forex has the capability to eat up any and all traders alive at any point in time. The reason why the traders make money, the ones that do, is simply because one, they're very picky, very selective of our entries. The right market conditions have to happen. The right sort of news cycles need to happen. Technical analysis, the fundamentals plus the market sentiment need to be aligned, right? That sort of stuff. If you trade daily and you're looking at doing anything more than about 3 setups every single week, you are running the risk of losing money. This isn't just a game we're playing. You're not playing the pokies here where you kind of just keep pressing the button until something hits. This is business. This is very highly technical. The big traders that make money off of this, like a lot of money, and I've seen traders that make 100K off each trade. They only take a very select few trades monthly, right? For example, with traders that just trade off the daily chart, right? Here is where an entry would have been, and I think I'm not sure if I actually put it into the video, but this is stuff that I was trading. This is stuff that a few of the traders that did sessions with me were trading around that time. Basically, we had a resistance area on a daily chart that was over multi months, right? So this was back in January, and then this happened in April, and then this daily candle here, where price hit a major resistance area, and then it came back down. Now, what happened there? It coincided with the weakening of the pound. And what that means is that a lot of news releases started coming through. For example, retail sales, housing data, construction data, CPI, GDP, all of that started to come out that gave us negative results. What that meant was there was a sign that the UK market was contracting. And as a result of that, there was going to be a weakening of the market, possibly even a risk of an early recession. And as a result of that, the pound started to weaken. Now, when we see this, right, what an experienced trader generally does here is they'll say, okay, and this is what I was doing around that time. I dropped a line on the daily chart every single time. Okay, we're going to have to go back and find this. I dropped a line on the daily chart. 17th April. At the close of the daily candle, right? So at this close, the line gets dropped. And then we jump back onto, and the reason why that gets dropped there is because certain data, and you'll see this in the fundamental series, the data that gets released, they're correlated with one another. So, for example, if retail sales figures are weak, we generally expect that CPI will start to be weak as well, right? And vice versa. If CPI and retail sales are weak, and you're getting housing data is negative, durable goods sales are negative, construction data is in the negative, PMI, PPI is all in the negative, we can be pretty certain that GDP is going to be in the negative as well. All right. So when that sort of stuff starts happening and we see these signs, and it's as simple as just looking at the news releases and simplifying it further, red, bad, green, good, right? So looking at it that way. And so what I do here is, if at the close of this daily candle, I drop a line in and I don't take a trade straight away. Why? See this wick to the high? That's the drawdown. I don't want to trade the drawdown because here, that's like 25 pips or 31 pips in actual fact. Now, as you go up in the number of lots that you trade, like one lot, that might not be so much of an issue because that could be about 250 to 300 pounds in drawdown, right? But if you start going into, say, 5 lots, that's about close to 1,500 in drawdown. If you go into 10 lots, that's about 3,000 in drawdown. And however long that's going to be in drawdown, we don't know. Like that may be throughout the Asian session, and then it'd be Frankfurt Open or London Open when market starts to move back down again. All right, so let's have a quick look at the 15-minute chart and where price is. Okay, so we're going to go to okay, the other thing that I wanted to mention, guys, with ranging markets, see how the markets have been ranging quite significantly. All right, so let's go here. Here is where I was looking at. When the market starts to range, and we'll get back to this, I've got it written down. We'll get back to this. It's better just to kind of avoid the markets, go do something else, because that's where traders come to die. That's where accounts come to die, realistically. Okay, so here's where the line was drawn in, and this is what the first red candle did. So notice how it breaks down below the 200, and technically we'll be expecting some sort of double bottom formation going up. But because we've seen a negative with the fundamentals, we now sit back and we're expecting that this market will most likely either consolidate or head back down again, right? So, and this is, I remember this was actually a key news release that happened that was quite bad for the pound, and we were expecting this. How do you see this? You can just read articles on Bloomberg.com or investing.com or forexfactory.com or FX Street or wherever it is. If you see that, and articles are suggesting to you that we're expecting lower than forecasted data, then there's every chance that this market is going to move south because that currency is going to weaken. And at the same time, we're looking at the currency pairs that we're trading, so we're going to kind of correlate with each other. If the pound is weak and we're seeing sure signs that the US dollar is strong, then that creates an ideal environment for us to trade the pound, because we know if pound is weak and US dollar is strong, the pound USD is going to fall, right? And if that is in line with a news release that's happening, that we're expecting to be in the negative, and there's going to be like key releases. So again, when we go through fundamentals, key releases are just a handful of them, like retail sales, CPI, GDP, PMI, PPI, housing data, construction data, that sort of stuff. When we see them, because they are what the central banks pay attention to. And again, we'll come back to that. But when we see those news releases happening and we know that the expectation is going to be weaker than expected data, then we can look for the market to weaken at that point in time. So we kind of align our technical analysis with whatever the prospective fundamentals are with market sentiment, and that's going to give us the overall fall, right? So I expect that's where I drew my line in. It was for here, right? And then I'm expecting price to go up. At some point, it's going to come back down and break this line. So once it breaks this line and gives me some sort of structure, so see this, multiple wicks to the high, there's a retest of this line as well. That's Asian session open. It's been retested after this break. And then price starts to push down. Your entry is somewhere down here, because off the daily chart, we recognize the structure. And off the daily chart, we're recognizing that the price is going to weaken. So what you could do is, if you did not take an entry off the close off here, which is what I'm suggesting you don't do, you bypass all of this. This is what the close to 30 pips was, which is the whole entire Asian session. Market goes up and then falls back down again, right? That's how you can kind of align your setups. Now, just looking off time, guys, this is, thanks, Steve, 10:15 already my time. So we started, I think, 9:30. So what I'm going to do, jump back on and complete criteria here, but I think many of you kind of get the gist of what we're looking for. So first of all, determine the trend. Is the market going up or down? How you can do it is you look to see if price is above or below the EMAs. That's first thing. If price is sitting below EMA 200 and possibly below or around EMA 50, the market's trending down. If price is sitting above it, that market's trending up. If your EMA 200 and your EMA 50 is going sideways, chances are that market's trending, right? Even your EMA 800, if it's going sideways, chances are that market is not trending. Sorry, did I say trending? That your market is ranging. When your market ranges, please do not trade. That's where you will lose money. That's when I get these emails come through and say, this is wrong, this isn't working. I took a trade here in this market, just did nothing and went down, went back up again. It's because you're in a ranging market. That's the one thing that you have to decipher. Please demo as much as you can before you go live. And the reason for that is that you're really learning the differences between a trending market and a ranging market, or a consolidating market. You will know that when you're applying the criteria, most criteria, mind you, with market structures, if you can apply them anywhere, and in most instances, a ranging market will give you that structure, you will probably lose money doing that. For my criteria, you've got to determine the trend. Remember, there's got to be, in a trend going down, lower highs and lower lows. On a trend going up, higher highs and higher lows. We want to use the EMAs to justify the trend. So again, the EMAs have to be coming down or going up. If price is below the 200, it's trending down. Price is above the 200, it's trending up. Is there a recognizable structure on the 15-minute chart? What I mean by that is, do you have like a big channel that's happening, a channel going up or a channel going down? Do you see a massive head and shoulders formation starting to happen? Do you see a trend line that is breaking? Like, for example, if we go back here, I think it was pound AUD. Guys, this is going to be more of a longer than expected video. So this sort of stuff. If on a 15-minute chart we see that these lines are being broken, these lines are kind of price is constantly bouncing off these lines, that's somewhat of a structure that you recognize. And if you zoom out and you see that here's where price interacted with a 3200 and it's come down, so we're expecting this to be a downtrend. Why? The price is below the 800 and is also below the 200 at this point, right? So we're expecting price to do some sort of structure at one of the EMAs and then break this line. This line here is the structure that I'm talking about. Is there something that's recognizable? If there is, wait for that break, because as you notice, this is the king tide, right? Remember, we want to trade the king tides and the tsunami waves. So wait for that. All of this nonsense here, ignore it. This is where some of you are getting caught up in, where you're looking to trade all these little tiny setups. Ignore it. Wait for a clear structure of the EMA of the EMA 50. Sorry, when, say for instance, again, when market's going down, what we're looking for is price to have hit the 200 EMA, come down, hit the 50, come down, hit the 50, come down, and then we expect it to then make its headway back towards the 200 again. What does that sound like to you? Familiar? That's the Elliott wave structures, right? Does the market do the Elliott wave structure all of the time? No. We look for it. How? Who was it? Someone sent me an email and asked me for no. Harry. Harry sent me a message on Facebook and asked me about the Elliott wave structure. Harry, mate, the way that I do it is this. Um, a lot of the times when price is kind of clearly moving south or clearly moving up, and what I tend to see is like a structure that's been created at the EMA 800 or the 200, and then price starts to move, and then you see price crossing the 200 or the 50, and then this sort of break happens, like where price crosses the 50 and the 200, and then because the price is moving so significantly that the 50 and the 200, the space between them begin to widen. When that widening happens, then what I'm expecting is that maybe, just maybe, this may be the first leg of the Elliott wave structure. So what I would do is wait for the consolidation to happen, and then I'd look for a high point, which is this, and then I'd look for a low point here, and I'd then say, hey, actually this was Elliott wave structure, and then I'd say, where is my 618, where's my 382? So the first hit, remember the first wave of the Elliott wave structure, I'd like this to retrace back to 618 area. So in this case, it does. Right? I didn't know it. I didn't recognize it before. But in this case, it does. So we would grab a horizontal line, drop it there, right? And say, for instance, this is where you've done the recognition of this separating. Market consolidates and starts to move back up. What I would do myself is two things. Drop a line at 618, drop a line at 382. And then I'd look to see, okay, let me get rid of this. I'd look to see what price is doing around those areas. So notice where I'm not trading any of this. Guys, I'm not a day trader and I don't want any of you guys to be a day trader either. I'm waiting for price to come and do the overall structure for me. So when it does, right, it gets to here, and I'm thinking, just by the looks of this here, because there's a massive gap, that this is a Friday. So I would most likely ignore that setup at the 382. Remember, my Elliott wave structure pretty much says to me if it's the completion of the second wave, I'd like it to be at 618. So market opens up on Monday, goes up, comes down, and then starts to fall at our Frankfurt Open. And it also breaks our channel line. That is the market structure on a 15-minute chart that I'm talking about. It could even be the double top formations that we're seeing up here off the EMAs, something along those lines. Off the 50 EMA, you're only looking for, again, at certain times of the day, London Open, Frankfurt Open, New York Open, for an Asian session pen, maybe somewhere in the middle of the Asian session, that's in line with your fundamentals. We're looking for maybe about 20 pips off of that. Yeah, sure, you can get 10, 15 pips, but I want you to study the charts for what to you looks like 20 pip setups. Off the EMA 200, you're more likely to get anything above about 50 pips or so, right? So that's kind of safe trading. Yes, you can get more off the EMA 50. Usually when there's an Elliott wave structure where price creates some sort of structure at the 50 and then bounces off, yeah, you could probably get more than 20, 30 pips. And at that point in time, what you could do is just trail your stops a little bit manually. Okay, but off the 50, look for a safe setup. And again, that may be on like a Tuesday, Wednesday, possibly even Thursday. Monday Open can probably get you that. London session, New York session at times. But anywhere between about New York Monday to maybe about Thursday London Open is where you're kind of looking for those setups. Okay? Right, so I'm going to kind of move faster a little bit. We've eaten up too much time. Okay, same thing on a daily chart. On a daily chart, you're looking for like the overall Let me see if I still have this up. Okay, see where I've got these lines drawn in? All of these things. Usually what I do is I'll jump onto a daily chart and start looking for like setups. What I had here previously was a whole triangle drawn in because I had been expecting that price will most likely come back to this point. Um, we're looking at this as like a major resistance area, and it wasn't until like months later when price came back up to this point to hit it, is when I kind of realized, and then that was in line with fundamentals that this market's going to move down, right? So that's one thing. What we would do here, okay, is this. Notice how price breaks, does the retest of the EMA 200 and starts to move down. Now, what we could do is look at this as the high, and at some point, price is going to actually do a bottom out, right? It's going to bottom out at some point. We could say, let me just have a look at this. Yeah, this is one area here. Somewhere down here as well. Okay. Once the price bottoms out and starts to head back up, that's where you'll draw your fips in, right? And say, for instance, down here somewhere, price will most likely bounce back to 23.6, might go back to retesting our EMA 200, just like here, where price came down, consolidated, went back up to this resistance area, something along those lines. So price may come down here, or what it could do is price may come down here and retest this area here. Okay, so 133066 mark, where it will break, retest this, and then give you a confirmation coming down, and price may continue to move south. You'd align that with your fundamentals because that will say to you that price is, at this very moment, weakening because the economy is weakening. If we see the fundamentals say that the figures that are coming out is showing the market getting stronger again, the UK market, then we might see the market enter into more of a range, and maybe even push back up towards, say, the 200 or so. All right, so that's how we're kind of doing it. But those predictions aren't set in stone. You're waiting for price to actually come and do what you've predicted, as opposed to, I've predicted this, I'm just going to take an entry. Okay, but look for the structures, the double tops, the double bottoms, the big. I think I've taken some of this off, but there have been. This might still have it. Here we go. So these structures. So AUD USD. See how there's a channel going up, and once the top of the channel gets hit, price comes down. We're expecting this break, and not only this break. Look at this retest that's kind of happening up here. We're always expecting this sort of stuff. And once you see something you recognize, see if you can trade along with it. For example, here, price came down, then went back, hit the 200 and the 50, and look at this big engulfing candle, right? And when you see this happening off the 200 on a daily chart, then that's something you can actually look to trade. So what we do is say open. Remember, you drop your line, and then look to see what price is doing in the Asian session. Asian pair, so chances are the price would have done a hit to the 50 or something and come down. And that's basically what I mean. This wick, when market is trending on a daily chart, these wicks are the ones where they open and then go back and hit the EMA 50 or the 200 or something like that, give you a structure and start moving down again. So by the end of the day, that's 63 pips. At close. That's all it is. So if there's a message that I'm trying to get to you guys in this video, is that the analysis and how much of it that you do is extremely important. And it's not something where you just say, hey, here's prices at 50, I'm going to take a trade. Price is 200, I'm going to take a trade. See if it fits into your overall criteria. See if technicals, the news release that's happening, and market sentiment lines up. Read the articles on Bloomberg.com and Forex Factory and that. Why? Because that's giving you some idea of what the analysts are thinking. You know, like for example, let me talk about the trade copy just briefly here. too many people think it's as simple as setting up a master account, lining up 1,000 accounts with it, and then just replicating the trades I'm taking. It doesn't work that way because there's a difference between my 10, 15 lot trades and doing 10 lot trades on a master account linked to 1,000 accounts. That would be leveraged at 400 to 1. That would be equivalent to about $1 billion in the live market. Most of the institutions don't give a damn, especially when I'm doing DMA, which is direct market access, won't give a damn about my 10 lots. It means nothing to them. But when I've got $1 billion leveraged out in the market, hell yeah, it's going to mean something to them. So we can't take the small trades, like, when I'm doing the 30 pip trade off an EMA 50 anymore. I can't do just a short trade off the EMA 200 anymore. What will happen is that I will require analysts that we sit down and we're going through the overall market direction that the market's going to go in, right? So is this going to be now a 3-month weakening of the market overall? If it is, here's what the reasons are fundamentally that's backing the weakening overall, and then we'll analyze to see whether institutions are taking their entries, the bank advisories, are they in line with what we're expecting, and then we take an entry which won't be the best entries. Why? Because we'd be taking entries that's going to be expecting some level of drawdown. So that drawdown may be 20, 30, 50 pips or so, and then we ride that wave. That's effectively how a trade copier will work. That's why you don't see trade copiers out there that work extremely efficiently. That would mean 4 or 5 days back in the shop. That would mean analysts being hired. Now, I've looked at so many different ways of doing this trade copier without kind of affecting my freedom. Where guys, I don't want another day job. So yes, it's all kind of still there, but I'm still looking at mechanisms via which I'm not tied down to this. If I had 2 or 3 other traders out there that I can trust and say, hey, you guys can run this, but I will spend maybe a day or the week or something in it, and I will advise on the entries, then maybe yes. But please be aware and please respect the fact that I've got my freedom, and for me to come back and do this now full time, I would have to sacrifice that entirely. And the people that are kind of just demanding of that is being very selfish. So it's that. Understand that this doesn't actually work the same way as we do. This is why hedge funds generally will take your cash on board and then they'll just do the trading themselves. That's why the institutions have teams of analysts looking after various areas. Analysts will specialize in certain areas. You will have people just looking at retail sales. You'll have people just looking at housing data and the trends and how all of that correlates with one another. And then how does that give us overall movement of the currency markets in relation with other economies? All of that takes a crap load of time. With my trades, and I will give you some information as they come through when we do the fundamental series. But with my trades, I still subscribe to very expensive data releases like this, which is not available retail. It's just something I had when I was an advisor, and they let me keep it. So it's not available via retail. And again, what I pay for is basically a fraction of what I would pay for if I was to if they did give me retail access, that sort of stuff. So please be mindful that Forex, what I'm trying to teach you guys here, just this criteria, I'm trying to give you something that's very simple for you to be able to sink your teeth into. But there is a whole bigger world out there to do with what moves the currency markets, and you will start to see this as we go into fundamentals. Okay, all right. Just quickly, and I will put this down, guys, in below the info section of the video, so you guys can convert this to whatever language you'd like to do, just put into Google Translator. Okay, so beyond recognizing structure on a daily chart, we want to know if the market's moving based off technicals or fundamentals, right? Technicals you're aware of, as to see that here's just the market kind of hitting a support and resistance area. Here's the market hitting the top of the channel or the bottom of the channel or something along those lines, and then creating a structure and then moving. Or is there significant news releases that are coming that are in the negative or in the positive? Is there articles being written that analysts are talking about the current dollar or the pound or the euro doing better than expected because such and such is happening, that sort of stuff. That will give you a fundamental reason for it. In previous videos, some of you guys didn't like me talking about Donald Trump, but there's a reality that we've got to face, and that is that when President Trump, for example, the Iran deal, when he pulled the US out of the Iran deal, then what generally happened was, even though Iran doesn't provide that much oil to the world, is that oil prices started to skyrocket, right? And that did have an impact on the markets where it ranged. The other thing that you will notice is that this thing with North Korea, the on again, off again kind of rhetoric, that confuses the market. The market doesn't know how to respond to that. So a lot of the times when there's like political strife or there's economic strife, what you might see is that the safe currencies, which is the Swiss franc, CHF, and the JPY, the Japanese yen pair, or not the pair, the currencies, they will strengthen. And so as a result of that, you'll see all the JPY pairs will start to come down. You'll think, why is the Japanese yen strengthening at this stage? And it's simply because smart money is moving to the safer currencies. And you'll see the same thing with the franc. The other thing I wanted to mention with the franc just quickly is this, that the Swiss franc usually is like a safe, stable currency. It's not one that kind of moves. It's the Swiss stay out of all the political strife out there in the world, and even wars and things like that. So what we kind of generally see will be in effect with CHF, and this is me. Look, I didn't realize this until recently. I've never traded the CHF pairs ever. What I have done is I've always used them for correlation with the pairs that I have traded. But someone actually mentioned this something to me a while back, and she said, well, Shiva, why don't we just trade the CHF pairs? And I was quiet there for a second because it occurred to me that, yes, we should. If, say, for instance, the euro is weak, and we know that, or the pound is weak, and we know that, or the US dollar is extremely strong, and we know that. So if we see that, what we could do is recognize that if for a period of time it's going to weaken, we'll have a continuous flow of days when the CHF pair for that currency, like pound CHF or euro CHF, they will just continue being weak, right? Same rules apply here, that in this case, when we're looking at price coming down, we don't have to go do an analysis as to is the CHF currency strong or weak. We know that it's a very stable currency. It doesn't really do anything. And so what we can tell straight off the bat by looking at the CHF pair, and this is how I've used it traditionally, is to say that the euro is weak. And then when I jump back onto Euro USD or Euro JPY, what I know is that it's the euro that's weak here. So it's in my best bet to, and what I used to do again previously, is to trade Euro JPY, Euro USD. But I realized that, hey, I could actually trade Euro CHF as well. Right? So the number of pips you collect probably would be less compared to Euro JPY, but you can still trade the CHF pair. So it's a safe currency to be trading, right? Is the market creating higher highs and higher lows, lower highs and lower lows? We've already spoken about this. That's the actual trend that you want to be trading. Each session, each day, the market has to create a structure. If it's trending down, lower than the previous day. If it's trending up, higher than the previous day. And where do they come back to kind of pivot? It's at the EMAs, all right? Now, note, if you recognize pattern structures, determine where price presently sits within the structure and its rules. So, if we're seeing, say, the market channeling up, And we know that what we are expecting is that for the market to break below the bottom part of that channel, right? If price is down there, we're not automatically going to go long at that area, even if it's kind of giving us a clear structure. You can, but keep in mind your risk of market kind of bouncing back against you increases. So what we'd rather do is if the market's channeling up, if price hits the top channel line, creates a double top structure and starts to fall, maybe then retraces back to 618 of that level and then starts to fall, gives us a confirmation candle, then and only then would you be looking for an entry. Example, see up here, we wouldn't be looking for these entries. We'd be looking for these ones here. Let me just draw this line in, see how this fits. Okay, so this comes very close to the 618 area. Okay, that's at the top, that's at the bottom. So this comes very close to the 618 area on the daily chart to hit it and then come back down. So this is, once this does this confirmation candle, which is the engulfing candle for us, that's where we're looking for a possible entry. That's basically what I'm just saying in that, okay? Step 2 of our criteria, ascertain the kill zone. Our kill zone, as we've already spoken about with when I drew those diagrams down here, the elliott wave structures and stuff, it's basically our EMAs, EMA 200, EMA 50. That's where the most common ones are going to happen. At the EMA 200 and the EMA 800, that market structure, that double top, double bottom, sort of a triple top, triple bottom setup, will probably take either 1 or 2 sessions, or maybe sometimes 2 or 3 sessions. If price is kind of hitting a support and resistance area there, creating like, this, for example, where it's gone up and it's gone up again and it's done this, we're expecting this to be a bigger move going south. It's a triple hit now. So this would be that resistance area, right? So, and one of them may actually break and create a wick or something like that. But that's the familiar behavior that we're looking for. And if it's at, say, our EMA, like say this is an EMA's coming down, something along those lines, that's a very strong indication. So please look for only look for your kill zones only at the EMA 250 and the 800. If it's doing it at the 3200, then just maybe jump onto the daily chat to see if the market is doing a structure that you recognize. Because for all intents and purposes, if price is at the EMA 3200, then chances are that whatever structure it creates may take a couple of days to kind of show up on a 15-minute chart. Okay? All right, let's move it along quicker. Okay, part 3. So we've got the trend, we've got our kill zone. The next thing is clear and recognizable market structure. We've spoken about this. Here are the market structures that we like: double top formations, triple top formations, head and shoulders pattern on a downtrend, on an uptrend, double bottom formation, triple bottom formations, head and shoulders formation again. We do like our tweezer tops and bottoms. There are in the previous videos where the Forex trading series in regards to market structure, the tweezer tops and bottoms are in there. And the structural retest that I've spoken about. Remember, when EMA breaks, the next candle is going to be a wick area, and generally speaking, I expect price to come back and then do a structural retest. That's one of the market structures that you can kind of utilize. Let me show you an example of that quickly. Zoom in. Okay. Where was this? Okay, it was this one here. This was last week. So this is a trade entry. Basically, it's, remember when I was saying that there was news release, I wanted price to kind of clear this area. It did. This was the middle area that I wanted it to clear. Came down, and then I wanted, usually when this crosses, I want a wick trying to hit this, or then there's the structural retest. This didn't quite hit the 50, but it created a continuation pattern. Here we go. Here. So it created a continuation pattern. My entry is here. Okay, this is where I took my entry at the open of this candle. It would have been much better if price went all the way to hit the EMA 50, but this is kind of the structural retest that I'm talking about. Okay. All right, so study the behavior of the candles that really matter. Are they moving quickly? Are they creating wicks? Which direction are they creating wicks in? That sort of stuff. That gives you some idea of order flow. So if, excuse me, if a red candle opens and it's bouncing up and down, it just means that within that 15-minute period, there is a mixture of orders coming through, buy and sell orders, right? If you've got very strong push coming south, then that just generally means that we've got more of the sell orders that are flowing through right now, and that's usually a good indication. That's most of everyone out there, the institutions in particular, are going in line with the trend, right? So if it's a very long candle, expect that the next candle is going to open up and create some sort of a wick at the top. And the reason for that is if for that 15 minutes, if all we've had is a long list of sell orders coming through, there's bound to be some buy orders in there as well, right? So price is going to push back slightly, and that's the reason why I always say maybe wait for a bit of a pullback and take your entry on the pullback. You capture a few more pips, and also if that price kind of closes as a doji, chances are you're actually on par or in the money at that point in time. Okay, candlesticks you should be familiar with by now: morning star, evening star, engulfing pin bar. The fifth one, so you've got your trend, you've got your kill zone, you're looking at a market structure at your kill zone, then you're looking at within the market structure, you're looking at a candlestick pattern, which would be something along these. At the most appropriate times, Frankfurt Open, London Open, New York Open, and then your confirmation candle. A lot of the times your confirmation candle is in line with this candlestick pattern. So your morning star, evening star pattern, that red or green candle, which should be the third candle, that's a strong one in line with whatever direction the market's going in. The engulfing candles usually eat up a couple of candles prior to that. So that and a strong pin bar. So if you're kind of trending down, see that double top formation, a double bottom formation, that sort of stuff. If we see a pin bar here, that's the price rejection that tends to happen, and also the stop height. Then chances are that you are set. Like after that, a confirmation candle comes through, and then take your entry. Okay, so very important that you have that. After your confirmation and your entry's been had, actually prior to entry, say for instance your confirmation candle is finishing off, the next step is your entry and putting in your stop loss. Generally speaking, I try and get my entries as close to my EMAs as I possibly can. I'd like to. The reason is because if I don't, then my stop loss is a lot bigger, right? Now, there is always been an argument, a debate about whether stop losses are necessary or not. Here's my point of view. You know when, and we're not too far off from robots actually trading the markets. There's already starting to be, with quants coming in, that more and more institutions are kind of following the line of just computer systems doing the trading. And less traders. I think institutional traders, they have a limited lifespan now. We're human, and we're always going to be human. And you will know throughout your trading career that there are going to be so many days where you have your ups and downs, like in your life beyond trading. And all of that sort of stuff is going to impact on how you trade. Even things like, when it's the full moon, it affects people. When planets, and here's an entire different video. Did you know we can actually predict if the market's going to be in a bear market or a bull market just going off planetary alignments, that sort of stuff. So there's going to be so many things that impact on your life, your family, your friends, news, and earthquakes, and whatever else it may be. And as a result of that, there's going to be so many times, and I guarantee you they will, there's going to be so many times when you will miss things when you take a entry. You'll miss it entirely. How I deal with it is that unless my focus is at optimum, I don't trade. You guys have seen me do this. I don't create videos when my energy levels aren't there and I don't feel like it, right? I trade the same way. If I'm not focused on trading, I won't trade. Yesterday, I really didn't feel like trading. I didn't even bother looking at the charts. So it's that you've got to kind of follow through with that. Now, that's where the stop loss is for. It's that just in case you've messed up, that instead of the market going completely against you, that you're able to salvage your account. Me personally, I rarely have gotten stopped out, and I think it's simply because I'm not there trading when I'm not up to it. But when you are focused and you are up to it and you follow this criteria to a T, and everything says to you this market's moving in a certain direction, you take your entry at the right place, you shouldn't need a stop loss. And if you take into account technicals, market sentiment, and fundamentals, you will not need a stop loss. But please put one in again for the primary reason that you're human. Okay? All right, just quickly what not to do. So I think this is going to be about a 1.5 hour video. So basically, do not overtrade. Remember I've said to you guys, don't day trade. I don't day trade. If I started day trading, I'd be losing money. Don't day trade. For all of you that have been coming to me with your emails to sessions, and a few of you that have gone ballistic, and when I speak to you guys, you're day trading. Anything more than about 2 or 3 good trades a week, it's just too much. You could focus on maybe just 2 or 3 50 pip trades a week. Right now, when I'm saying to you guys, focus on 2 or 3 20 pip trades a week, what I'm basically just trying to do is build that muscle memory that you guys get in the habit of kind of jumping in, taking a trade, following this criteria and getting out, and then at the same time assessing how far that market's moved, how many pips you could have made, that sort of stuff. Study that for a prolonged period, of minimum of 1 or 2 months. Don't jump from a micro lot onto mini lot onto like standard lots within just the space of a couple of weeks. And Tina, yes, I mean you. That sort of stuff, it's going to do more detriment to you in the longer term because you're not going through the necessary learning curve. All right. Eventually, you will be bitten, and that's going to kind of force you to walk away. But you do need to go through the learning curve. So reduce the number of trades that you do first of all, and work on how many pips you'd like to make. Because eventually, guys, remember, if someone's saying to you, "I made 400 pips this week, 800 pips the previous week, and whatever," I don't want you going down that path. Don't let that distract you, because to be honest with you, you only need about 50 pips a week to be able to make good money on it, because eventually you'll just be putting more and more lots onto it. Okay? Do not trade against the EMAs. We've already discussed this as well, that if the market's trending down and we're looking for double top formations happening at the EMAs coming down, we're not looking for double bottom formations going back towards the EMAs. Because there are going to be times when, yes, you look at it and say, oh, I shouldn't have listened to Shiva. Market went all the way up. There was like 50 pips there back to the EMA 200. Sure. But out of 10 times, that might only happen 5 or 6 times. Right? So, or maybe even less. So just be aware of that. We established these rules to kind of prevent those losses from happening, right? So don't go against the EMAs. Do not trade from a lower EMA to the higher EMA. Generally speaking, what happens is that when you're moving from a lower EMA to a higher EMA, you're going against the trend. Right? So from the 50 to the 200 to the 800, if you trade this way, you're going against the trade. We kind of want to trade with the trend, okay? With the trend. Higher EMA to lower EMA. Do not trade if you are unsure of the trend bias and the predicted move. So basically, when we're looking at the market, and say, for instance, the market's doing this here, and we're not entirely clear on where this market's going, there's a simple solution to that. Don't trade. Find another currency pair, okay? Where are we? Do not trade the second half of New York or the first few hours of the Asian session. That's been established rule already. A lot of you are breaking this rules. I really can't help you there if you're going to break that. It's just generally saying the volumes are going to be low. Institutions don't take their positions around those times. So if you're taking it, you're kind of jumping the gun before they do, and in doing so, you better have your third eye open and your able to kind of see into the future as to what the market's going to do. When it comes to Forex, it's kind of a less of a pain in the backside to kind of avoid that entirely and just kind of wait to see what the institutions are doing before you jump in. Do not enter halfway into a candle unless it's a pullback. Remember, basically, it's that if the market's trending down, you want to trade or take an entry when the candle's green. Simply because that's possibly where the wick space may be. But if the candle's already red on a downtrend and you jump into it, you're running the risk of that price kind of coming down and then pushing back up against you. So one, you can end up being in the wick space below the candle, and then the market kind of pushes back up to do another hit to the high or something along those lines. It's always best to let the candle complete and then confirm for you as to what it's actually doing, right? You already know, do not trade in a ranging market. Always wait for the market to complete structure. So remember when I was saying about structure, like too many people are saying, I don't see it in real time. That's because you are possibly trying to gauge it up here. Don't. There's no point, or even here, there's no point in doing that. Let the market structure complete, right? Let this price come down to this halfway mark. When it's there, that's your confirmation. Like, how would you not be able to see this completed structure? Same thing with a double bottom formation. This is what I'm talking about. The confirmation candle usually, the engulfing candles will usually take you to this middle area. Here's forget this part. This is your double bottom formation, right? Forget these two parts. That's your double bottom formation. So when price is here and this is where you're looking for your entry, how can you not spot the structure? Okay. Where were we? Always wait for the middle part of the pattern to be crossed if the structure isn't clear. Yep, this is what I was just mentioning. Always treat an EMA as a support and resistance area. That's critical. If you're looking to take a trade in one direction and there's an EMA there, which is like the 50 or the 200, always expect price to kind of bounce off it, be the opposing candlestick color or something along those lines, or maybe consolidation to happen around that area, because our EMAs are dynamic support and resistance areas, right? I've seen a lot of people ignore them as well. Trade only when you know the reason for the market movement. So remember when I was saying, is it fundamentals? Is it technicals? Market sentiment? What's kind of moving the market? Is the euro weak, and that's the reason why it's falling? Is the pound weak, and that's the reason why it's falling? Is the US dollar strong, which is the reason why it's climbing? That sort of stuff. Try and decipher why that market is moving before you jump into it. Knowing the reason for its move will give you not only the confidence as to your entries, but also it will let you know the possibility of where it's going to. Okay, if you take an entry, and so many of you are taking entries not knowing what the market is doing or why it's doing what it's doing, yeah, you're going to have losses. So don't do that. Do not take late entries. When I'm talking about entry setups, when I say we've got this, take your entry here, take your entry here, a lot of people are seemingly taking entries up here and down here and sort of stuff, and chances are your EMAs might be, say, here. If you've taken that late entry, this market could actually push back to do a retest of this EMA. And for that duration, and you don't know at what point that could do that. I've seen a lot of people take very late entries, and they have the drawdowns happening as well. You don't know when the market could push back up to do the retest of the EMA. This is another reason why I say if you're close to the next session opening, wait for the next session to open. Why? Because say for instance, this is Asian session here. This is London open. Market goes up, hits this EMA, starts to come down, and then we're going in towards the open of New York. So say, for instance, the market pushes back up and in New York open, it pushes all the way up to the EMA 50, and then comes back down, gives us a strong confirmation candle coming down, maybe about an hour and a half into New York Open. So for that duration from here to here, you would have been in drawdown. It's always better for to let price kind of go back to an EMA, come back down so you're closer to where your entry should be, and then you take an entry after that engulfing candle and move south. Something that I haven't, okay, let me just finish this up. Do not trade ranging markets. I think I've already mentioned that. Do not trade when mentally, physically, emotionally exhausted. I've covered that as well. Here's something that I probably haven't mentioned. The likelihood of double tops and double bottom formations happening is highly likely in Asian and London sessions, right? With New York, if the market is already trending from Asian and London, in New York, you're more likely to get the candlestick structure, like an evening star, morning star, or maybe like an engulfing candle happening, as opposed to a complete double top and double bottom formation. Remember, it's got to be at the EMAs, but this has to be completely in line with it. I would still prefer that you wait for a complete structure, simply because that the complete structures will give you more of the in the money rate. Okay. Now, lastly, I just want to reiterate this point. Do not overtrade. Don't look for daily setups. Get into the habit of doing your analysis over the weekends, even throughout the week, whereby you might wait for a structure to happen on a currency pair that you wait for a couple of weeks to get to. Quick example. See, with AUD USD, I showed you this, right? Now, this here usually is not something I trade, this currency pair. I don't really like it so much. But notice that I had this drawn in. I think I drew this in from at somewhere at this point when price started to bounce off here, right? So I drew this in. We had these points matched and these points matched. And so I waited. When was this? This is from 2016. December of 2016. I've waited all the way from here till now for this break to happen, or to be able to trade this structure here. This come down, right? So notice how that's from December of 2016, and we are in May of 2018, right? That's a good, what's that, 15 months? That structure, that analysis that's been done, because I really didn't want to be trading all of this sort of stuff, but this structure and the recognition of it back then allows setups to be formed for me in the future. And I've just kind of left that be, and I will adjust this at times given where the market kind of hits and bounces back from. But the adjustments allow me to be able to say, hey, I could get a more of a precise entry, and it gives me easier analysis for like future points. So on a Saturday or a Sunday, when I look back at the markets and I'll go through the daily charts, I'll be reminded again of AUD USD being in a channel. And I'll say, okay, price is there, price is maybe at the EMA 200. So for that week, I might write that down on my piece of paper, the trading guide for the week is to say, keep an eye on the AUD USD. It's doing such and such on the daily chart, right? Remember, guys, at no point do I day trade just off what I think the market is doing just within that session. You want to do the overall moves. Why is the market moving? Is the Aussie dollar getting weaker or stronger? What's it showing me on the overall time frames? That's the top-down analysis. There's a video on the channel, probably in the last 5 videos, that does a top-down analysis. We predicted the pound move in that as well, and also what's happened with USD, JPY, all the way up to the price point 110, that sort of stuff. Pay attention to that. All right, guys, I think that is it for this. It's a very long video. It's about 1.5 hours. So please break this down and watch it as you go on. Please do ask any questions that you have below the video, and I'll try and answer that, so that will help everyone else. All right, guys, that's it for now. We'll start doing the fundamental series hopefully this week. I'll start up on that, and then we'll take it from there. All right, all the best to you all.